Buying real estate with your IRA, good idea or a bad idea? Let's discuss that today. So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information, links to articles, etc. on today's topic. And if you find this video of value, please do consider subscribing. Besides these type of videos, we have a weekly market update, which I'm sure Michelle's putting up there right now. So, buying real estate with your IRA, good idea or bad idea? I've had that question, I'm not going to say a lot, but I've had it several times over the years. So what I've done is I've put together high-level points, 7 points in particular, and then a little bit of discussion ideas here to determine whether or not it's a good idea. So, first up, your IRA cannot purchase property owned by you or a disqualified person. What exactly does that mean? Well, can I have my IRA buy the home that I'm living in? No, you are not permitted to live in that home. And then disqualified person, who is that? So let me think about this. Disqualified, children, spouse, grandchildren, great-grandchildren, disqualified. Point number 2, you cannot have indirect benefit from a property owned by your self-directed IRA. What does that mean? That beach home of your dreams? Sorry, you cannot buy that. Not allowed. Again, you're not allowed to be inside that space. Number 3, how do you title this? Keep in mind, you and your IRA are two different entities, right? So you have to make sure that if you're going to do this, it is titled correctly. In this case, it's going to be Equity Trust Company. That's the custodian, or XYZ custodian. FBO for the benefit of John Smith. That's who you are. Okay, and then IRA. So again, XYZ custodian, FBO, John Smith, IRA is how it should be titled. Number 4, real estate in an IRA can be purchased without 100% funding of your IRA. And that's actually a good thing. I'll explain more in a bit. But the bottom line is you don't have to use all of it. So if it's a $500,000 property, you could put $400,000 towards that and leave $100,000 in, which you will probably need for reasons we'll discuss. Number 5, IRA investments that use financing must use or pay UBIT. UBIT, unrelated business income tax. Not going to get into that, not a tax expert, know enough of it to be dangerous, but we do have a link to an article below that can help explain that. Number 6, and this to me is one of the most important ones, expenses must be paid from your IRA. So if you have a roof, if you have a HVAC situation, carpets, you name it, you cannot use money outside of your IRA to pay for those expenses. So again, that's why you have to make sure you have enough money in that IRA to take care of those expenses, and also including mortgages. Number 7, last but not least, real estate income must return to the IRA. Of course, right? If you're getting $2,500 in rent, you can't slide $500 in your pocket for a little bit of cash flow. It all has to go right back into the IRA. Other items to consider before we give our recommendation: IRA owner is unlikely to be able to recognize tax losses. Think about that. If you're buying stocks in your IRA and you buy it here and sell it there, you have a loss. Can you realize that? No, you cannot. You can only do that outside that IRA, so you have to be careful with that, okay? Depreciation cost, again, there's another item you probably won't be able to do, and that's generally one of the big things when it comes to having real estate as investment properties. The owner, IRA owner, may have to recognize some taxable income, even if the real estate is in an IRA. Again, that's for your tax professional. You may be turning long-term capital gains into ordinary income. Think about that, right? Why does that matter? Because ordinary income is taxed at a higher number. And then Each year, every year by 12/31, you have to have that property appraised, and that's $500 to $750 a year in additional expense. So what happens if you have what's called a prohibitive transaction? Prohibitive transactions apply to self-directed IRA. In this case, if you live in that house, okay, that would be prohibited with real estate in an IRA. The IRA is considered terminated the first day of the year of the prohibited transaction. You got that? So what exactly does that mean? Well, one, you're going to have to pay taxes on all that amount. If you're pre-59 and a half, you're going to have to pay additional 10% penalties, right? You also lose the benefit of having that money in your IRA all those years that would have been retained for your retirement. So, conclusion, thoughts, recommendations, ideas, right? Real estate, what do we like about real estate? Well, I mean, long term, it's a hard asset. Obviously, I'm a believer in hard assets in our investments when it's appropriate. But like any investment, it can go up or down, so you have to be careful about that. You factor in all these other factors as far as taxes, expenses, etc. Doesn't make a lot of sense. The other thing is, not a lot of the top level custodians allow it. So our custodian's Fidelity, they don't allow it. Most of the major brokerages don't. The one client that did this with some custodian in Michigan, I mean, they are not what I will call a tier 1 custodian. So what kind of protection do you have there? Not saying there's a problem, but you need to look into that. So there's a lot of factors there. So for me, I don't recommend this. I think there's too many restrictions and not enough benefit to use your IRA assets, because at the end of the day, you know, real estate appreciates historically at 3%. And if the market is going forward, you have an opportunity for possibly better returns. So, as always, we appreciate you watching. I hope you found this a benefit. This is Michael Loftus for Wealth and Wisdom TV.